IRS rule change that affects commercial property owners. The legal changes that took place were the result of a lawsuit in the U.S. tax court involving the Hospital Corporation of America. At the time, they owed the IRS $800 million. Judge Tom Wells presided over the case in August of 1997, and the precedent that positively affects many commercial property owners was set when the Hospital Corporation of America won that case. The Hospital Corporation of America based much of its case on another precedent-setting case which involved Walgreens drugstores. Walgreens had already won a case at the district court level which gave Walgreens the ability to change the way their properties were depreciated. The result of an acceleration of depreciation on the properties, thus reducing their tax liabilities because of the larger depreciation expense created. What had been happening prior to 1986 was that all commercial properties, for the most part, were depreciated on either a 39-year or a 27.5-year schedule. In the Walgreens case, it was argued that they should be able to take the personal property in their drugstores and tax-wise view and depreciate it differently than the structural part of the drugstores. As a result of winning that particular lawsuit, they were then able to take a large portion of their depreciation in a 5, 7, or 15-year application rather than the standard 39-year application. Let's go back to the other case. The Hospital Corporation of America realized that the district court had favored Walgreens Drugstore's argument. So when they went to court, their chief counsel asked the IRS representative, why is it that commercial property owners in America do not accelerate depreciation based on their personal property versus the structural parts? And the answer that was given by the IRS representative was, well, the service knows that they should, but we're not going to tell them. With that flippant answer, the judge ruled in favor of the Hospital Corporation of America. This ruling created new guidelines for commercial property depreciation and the birth of our company, Cost Segregation Services, or CSSI. The president and founder of CSSI, Jim Shreve, an engineer involved in that case, began to make cost segregation affordable for owners of smaller buildings throughout the country. Now, having completed over 6,000 studies around the country, we have established CSSI as the premier company in providing engineered cost segregation. CSSI works with CPAs, attorneys, and tax professionals in every state of the country with great success. This being said, many tax professionals sometimes have common misperceptions regarding cost segregation. CSSI is an accounting firm. CSSI is not an accounting firm and cannot and will never replace the valuable services the CPA or other tax professionals provide their clients. Number 2, all of the depreciation has already been taken. Even though a tax professional may have taken some accelerated depreciation because they are not engineers, CSSI will find an additional 70 to 90% in depreciation expense. The depreciation expense is passive. 90% of the time, not true. Even with passive income rules, over 90% of business owners can take advantage of cost segregation. Cost segregation can be done only on new buildings. Not true. We can go back as far as 15 years sometimes. Cost segregation can only be done in the first year of ownership. Again, not true. Cost segregation makes sense only for larger, expensive buildings. CSSI routinely completes studies on buildings with a cost basis as low as $350,000. The cost of a study does not make economic sense. In most of our studies, CSSI attempts to return at least 10 times the money invested. It is better to take the depreciation expense over 39 years. Most business owners, as well as financial professionals, all know and understand the time value of money and the significant advantage of getting deductions now and using the money today rather than waiting 39 years. When the building is sold, all of the depreciation will have to be paid back. Not true. First, there's no depreciation recapture when a building is sold using a 1031 exchange or is acquired by their heirs upon death. Few commercial properties are sold for cash. Even if the property is sold, the actual amount of the recapture is very, very small. A cost segregation study is risky. Simply put, a properly engineered cost segregation study is not risky and will not trigger an audit. Cost segregation is the proper way to depreciate commercial property according to the IRS. The IRS recommends that to be fully compliant, cost segregation needs to be performed by a third-party engineering company. We hope this short presentation has shed some light into the possibilities and benefits of using our company, CSSI, and cost segregation. Our goal is to provide incredible value to both you and your clients. For over 10 years and over 6,000 cases, we have consistently provided engineered cost segregation studies with 100% accuracy. If you would like more information, you can fill out the form on this page and we will email all of our contact information. And know that we will not share this information with anyone. My name is Patrick Hamilton. Thank you for taking the time to listen to this presentation, and we look forward to having the opportunity to providing the same high value to both you and your clients that we have for so many others. Thanks.